Your first take on this one?
Sure. So I think there were some positives in the form of this. Inflation has clearly peaked. I think we're seeing goods inflation continue to decline. What I'm a little surprised by the market reaction is that the service inflation, so service CPIs, shelter inflation, core services ex shelter, that's still high. It's actually accelerated over the last couple of months. I think if you take the Fed at face value, that's what they care about. I think the easy part of the decline in inflation may be underway. Goods inflation is declining, commodity prices are falling. The much harder part is getting that service inflation down consistent to 2%. I think the market thinks that, they can extrapolate this trend and that the Fed has maybe one or two more 25 basis point hikes. I think the Fed may have to actually continue to hike. So our call is 5.5 for that terminal rate. We're calling for a 50 in February. I mean, maybe that's a 25, but I think the Fed's going to say we're not done. I think the market's a little too optimistic, extrapolating that this decline in service inflation will continue. And historically, service inflation is very sticky on the way down.
Just how much demand destruction do you still think we need to get inflation to where the Fed wants to see it?
So I think we need a lot more demand destruction, particularly in the labor market. I think businesses are hoarding labor. Wages did come down a little bit last week, but you still look at year-over-year wages well north of 4.5%, not consistent with 2% inflation. I would also argue the lags point, the long and variable lags. The Fed is looking at data right now, and that data on the labor market does not suggest that demand destruction. How forward-looking can the Fed be to say that we think this demand destruction will happen in the labor market 6 months out? I think if you take them at face value, they are saying they're responding to data as it comes in. So, our view is they are going to be late. And I think the market is cheering. We're pricing in more rate cuts at the end of this year, more cuts next year. I think that is a mistake because the Fed is telling us they're worried about the mistake of the 70s. They really want to see that 2% inflation. And my views are there are structural forces that's going to keep inflation high. Until the Fed accepts that and is perhaps okay with a 3% inflation, they are going to be really reluctant to, I would even argue, stop hiking, let alone start to cut rates. So this optimism why the 2 years falling is all these cuts getting priced in. I think that can get taken out as we hear from the Fed that they can stop at, maybe it's 5.25 or 5.5, and then they're going to just stay there for a very long time while that demand destruction that you talked about is an intended consequence of policy, and they have to see that through. And I think the market's already looking ahead to when can that easing happen. I think we'll be waiting for quite some time.